Welcome back. Let's get a corporate conversation going. eClerx is on our radar. The stock is up 2.5%. They've delivered a pretty good Q3 performance. Revenues have gone up by more than 3% on a quarter-on-quarter basis. Margins are down 30 basis points sequentially. To talk about the way forward, we're joined by the company's CFO, Nadadhur Srinivasan. Morning, and thanks so much for joining in. Can we first talk about your revenue growth? 3.2% on a quarter-on-quarter basis. Was there an impact on account of furloughs? Can you quantify that? And do you expect the furloughs to spill over into Q4?
Okay, thank you. Thank you firstly for having me. So I think we did pretty good in this quarter. 3.2% is very strong growth, and we are pretty happy with our performance. We are not an IT company, and therefore there was some we do some IT work on the side, but it's not a primary driver of our revenue. So while there was some impact of furloughs, there was not a lot. What we expect for Q4, I mean, given the macroeconomic situation, we do expect some kind of moderation of demand for Q4 as well as for the rest of the year.
Okay, Mr. Srinivasan, when you said there was some impact of furloughs, can you quantify that for us? And about the macroeconomic situation as well, what does it do in terms of your revenue growth going forward as well? You had given a guidance of FY23 revenue growth will be in mid-teens. Considering what we are seeing in Q4, do you think you will be able to achieve that?
Second question first. So I think we've already achieved what we said. I think we said double-digit growth between 12 and 15. I think we've already done that in 3 quarters. So I don't think that's going to be much of an issue. The furlough one is insignificant as far as we are concerned.
Okay, good morning, Mr. Srinivasan. You've already taken us through the revenue guidance, but on the margins, you had guided for 28 to 32%. Can you tell us if this still looks attainable to you? Because right now it's a little bit below that.
So our EBITDA guidance was for 28 to 32, and we are still in that range. And I expect that even in Q4, we should be able to stick to that level. Although we may be at the lower end of that 28 to 32 range.
Okay, so FY23 revenue guidance, you're holding on to 12 to 15%, and EBITDA margin guidance will now be at the lower end of your guided range of 28 to 32%. You started off by saying that you anticipate some moderation in growth in Q4 and the year ahead. Can you tell us what is it that you anticipate? What could next year look like?
So it's kind of difficult to predict, but the overall macroeconomic environment is so uncertain. With especially in our client geographies of Europe and North America, where most of our clients are. So it is kind of difficult to predict what the impact is going to be, but we do see that demand may not be as strong as what it used to be in the first 9 months of FY23 or even, last year.
Okay, so give us a sense of how the deal wins have been in Q3 and what is the pipeline looking like, since we are talking about the demand weakness that you could possibly see. Have you seen any cancellations, so to say?
We have not seen cancellations, but we do see clients taking a lot more time to decide on how much they want to spend, when they want to spend, when they want the spend to start, and so on.
And what was the deal wins this quarter?
Actually, we don't release information or we don't disclose information on deal wins.
But I'm sure your investors would like to know now also, because your Q3 numbers are already out. Was it an increase versus Q2? Was it stable, flat, or did it see a decline?
I think year on year, there has been an increase, which you can see reflected in the results. But we don't release specific information on deal wins.
But no cancellations at all, right?
Cancellations, no.
Okay.
Delays, yes.
Okay. We also noticed that your top 10 clients is down a little bit sequentially. Can you tell us what is the reason for that?
The top 10 clients are where we have a bouquet of services with them, including IT, including operations, including onshore. So there has been a little bit of drop on the onshore revenue with the top 10 clients. And, if clients are looking to cut costs, the onshore one tends to be higher cost and therefore easier to cut.
Will tech budgets be lower this year, 2023?
I'm sorry.
The
Can you
tech
repeat that, please?
budgets, the tech budgets for your clients, do you anticipate a cut?
We do expect that it will be lower, yes.
By how much?
Difficult to say, 10 to 20%.
Oh, so would that mean that for you, revenues could be flat, low single digits for FY24? Because it's a very sharp budget cut of 10 to 20%, right?
So tech budgets, I would classify that in two buckets. One is discretionary spend, which is likely to see a cut. The other is run the bank kind of or run the business kind of spend, which may see a lower percentage of cut.
Okay. All right, Mr. Srinivasan, thank you so much for joining us and detailing what the demand ahead is looking like. That's the word coming in from eClerx. With that, we'll slip into a short break now. When we return, Budget 2023 has ended the tax advantage in market-linked debentures. What does it mean and